afternoon and welcome to our latest virtual roundtable brought to you by Bridging and Commercial and kindly sponsored by Octopus Real Estate. Thank you very much for joining us today. My name is Beth Fisher, editor at MediaNet, the publisher of both Bridging and Commercial and Development Finance Today and the bi-monthly print Bridging and Commercial magazine. Today, we will be discussing the changing appetite of buy-to-let investors this year and beyond. CNC has reported on numerous new or enhanced buy-to-let offerings from lenders in recent weeks, with Octopus Real Estate being one of them. The lender re-entered the buy-to-let market with the launch of new residential products in March due to increased opportunity in the buy-to-let space. According to Arla Property Mark's March PRS report, the number of new prospective tenants rose for the third month in a row. The number of agents witnessing landlords increasing rents grew to 60%, and the amount of properties managed per branch decreased last month. In terms of location, the West Midlands had the most rental stock, while London had the least, painting a better picture of where supply and demand lies. A report yesterday found that almost a fifth of landlords intend on investing in property over the next 12 months, especially by those which already manage larger portfolios. It will be interesting to see what areas of the UK will see most of this investment, especially since living and working arrangements have changed for many as a result of the pandemic. I, for one, joined the moving out of London bandwagon last year, and we may see this trend continue and companies implement a more hybrid approach to office and home working. In addition to how tenants' needs are altering and how the market invests in PRS, it will be interesting to hear from our panel today on whether the landlord profile is changing in terms of experienced investors, first-time landlords, limited companies, and foreign nationals taking advantage of the current demand for rental properties. We hope today's discussion will uncover some of the main trends in the specialist buy-to-let markets and also answer some of our own questions throughout this morning's session. Joining me today are a fantastic panel of experts in the buy-to-let market, and now is the perfect time for me to hand this over to our panelists, who will each spend around 2 minutes introducing themselves. So let's start with Dimitri.
Thank you very much, Beth. So I'm Dimitri Zaprzala. I'm head of residential lending at Octopus Real Estate. So I look after both the bridging and the buy-to-let product sets. And then the sales, credit and customer functions. I've been with Octopus now for approaching 10 years, and look, really excited to spend the next hour discussing this in more detail. Apologies, you said 2 minutes, and my intro is nowhere near that, so I'm going to see if anyone else trumps me with regards to timing on that.
Thanks, Dimitri. Steve?
I'm not sure I'm interesting enough to fill 2 minutes myself, but what I will say is, Steve Matthews, and I am also at Octopus Real Estate, and I'm our head of buy-to-let. So I kind of work on the product side of things, the sales side, just basically overseeing what the opportunities for our products within the market are. I've been with Octopus since 2018. Before that, I was 5 years at Shawbrook Bank, but all in all, about 20 years in financial services, always on the mortgage side, and that's run through being a packager, a broker, and a lender. So quite a broad sort of view, I guess, across all of these different topics. But as I say, at the moment, very much, my day-to-day job is all about buy-to-let. That's probably about 45 seconds. So.
Thanks, Steve. David?
Oh, hi, yeah. So I'm David Williams, and I'm the Managing Director of Results Asset Management. I've been involved in property since 1983, when I left college. Subsequently, I had an estate agency for some years. And I've looked after Octopus's asset management since they were Drawbridge Finance. So I think that's around about 13 or 14 years ago now. They started off with 4 people and me. Our role entails quite a mixed bag, really. We look after the development side, commercial, buy-to-let, residential bridging, refurbishment work. We go out and look at the properties. We audit the valuations. We do monitoring of works, downs. And we also do sort of kind of occupancy checks on properties, stakeouts if required. So that probably lasted about a minute, I reckon.
Thanks for that, David. James?
Morning, and thank you for inviting me onto the panel. My name is James Harris, and I'm Director at De Villiers Surveyors. I've been in property since 1989, became a chartered surveyor in 1992, and I spent the last 30 or so years specialising in the residential sector. I set up De Villiers about 14 years ago to provide valuations for lenders. And whilst that remains my speciality, over the years we've sort of branched into commercial arenas such as rating, lease renewals, and more recently LPA receivership work. And that was, a lot less than 2 minutes.
Thanks for that, James. Matthew?
Hi, good morning. My name's Matthew Rowan. Although I've been in the lending space for 20 years, director of BTL broker, multi-award-winning national specialist finance broker. We were established in 2013. Been privileged enough to enjoy year-on-year growth since. We transact circa 40–50 million pound of lending a month, and we're incredibly proud to carry out our FIFO Service Award for what we do, which is not easy in our industry. And I think it's a testament to the wonderful team we have and the relationships we have with lenders and clients, and generally our transparent and ethical approach to business. We officially launched our sister brand earlier in the year, the Bridging Broker, and we continue to operate in all specialist fields, including very much limited company lending, HMOs, multi-unit freehold blocks, and more importantly than all of that, I'm a husband and father to 3 wonderful children who challenge and inspire me in equal measure every single day.
Thanks for that, Matthew. And also we've got Alec, who currently you can't see, but he is on audio only just this morning. So Alec, can we hear you?
You can hear me loud and clear. Beth, morning. Thanks for the intro. Morning, everyone. Hope everyone's having a great week and looking forward to the weekend. Just brief about me, Alec Chohan, Senior Commercial Manager at Knox Capital Solutions. Been with them 4 years. Again, similar to the other guys there, sort of banking background, been doing buy-to-lets now with my current role for about 4 years, as multi-unit freehold blocks, new builds, HMOs, sort of where we tap into. Come from a property background. Prior to that, I was with mainstream banks, Barclays, HSBC, doing property finance. So been in property for 20–25 years now. Love what I do. It's really enjoyable, learning something new every day, and webinars like this give us the opportunity to share our opinions with what's going on in the current market. And yeah, a father, I may not look at it, he probably won't see me, but I'm a dad of 2. Yeah, and looking forward to this event and looking forward to seeing what questions you guys have for us. So thanks, Beth, and back to you.
Fantastic, thanks for that, Alec. So we're going to start the discussion now. I just want to remind the audience that they can submit, you can submit your questions in the chat box throughout today's discussion, and we will aim to answer these in the last 10 minutes of the session, but I will be filtering through them throughout. So my first question, just to kind of kick this off, is all about how and why landlords are having to adapt and evolve in the current climate. Dimitri, what are you seeing in that respect?
I mean, landlords, to be fair, have proven to be very flexible beasts now for a number of years. So obviously the COVID pandemic has affected everyone. I'm not going to dwell too much on that. I think there's been plenty of airtime given to that. But if we look at landlords over the last few years, whether it be tax changes, regulatory changes, the way in which they can borrow, the options and such available to them, I think they've had to evolve throughout, whether that be structuring their companies differently, looking at different types of property, whether that be for achieving the yield that they were looking for. We've seen new markets develop, such as HMOs, short-term lets. So I think that the job of a landlord over the last few years has evolved much, much more than it probably ever has done. So actually they were quite well placed for, say, the COVID pandemic and the challenges that brought. And if anything, looking back, it probably hasn't been as impactful as we maybe thought it was going to be for landlords at the beginning of the pandemic. Notwithstanding, of course, there have been challenges around tenants and employers, etc., etc.
Thanks for that, Dimitri. Steve, what would you add to that in terms of how landlords are trying to adapt?
Yeah, it's obviously going to be relatively similar to Dimitri, and I think with that question, there's two ways you can split it, and you can think about how landlords had to adapt throughout a pandemic, which is new to everybody, or you can look at the other way and go, how are having to adapt to a raft of changes that have been enforced on landlords since 2016. And I think that's probably the better side of the equation to look on, because if you go back to 2016, landlords before that quite happily going about their business. They had their business models and their strategies before they knew right, we're going to slap you some stamp duty, an additional stamp duty surcharge. You then got, completely unknown to really most landlords, the PRA wanting to get involved in the buy-to-let sector and actually regulate how lenders design and sell their products, and obviously the calculations attached to it. From there on, we have things like Section 24, another kind of thing for landlords to work out how does that affect their model. And it just goes on and on. You've got HMO license in 2018, EICR tests have to be done this year, obviously become mandatory. There's so many different things, additional sort of stamp duty for offshore investors. There's EPC ratings coming around the corner. So it's not so much a case, well, I think the question, which is how and why, is almost why are they having to adapt? Well, I think all of those answers explain why they're having to adapt. It's how they're now doing that. So that's where they're having to really think about, does the strategy they had before all these changes, is that going to help them and allow them to move forwards in the market as it is? And I think that's why you're seeing so many people sort of reinvent themselves as landlords, that they're not going out to their local town, buying a 2-bed flat and having a passive income. They're having to think about, where do I get yield? How do I create value? How do I grow my portfolio? And they're very different thoughts, I think, to what they were before all these changes really started for them in 2016.
Thanks for that. Matthew, how have your kind of clients changed their requirements since the beginning of this year? Have you seen any kind of marked changes here?
You're sort of the immediate climate. Obviously, you've had the COVID pandemic. That's created, huge changes. You alluded to it right at the beginning in people's living and working conditions. More and more people beginning to work from home, more and more companies allowing employees to work from home. And we will see, no doubt, over the next few years, a migration for some people, for tenants, and then following landlords, away from the city centre and the cost of city centre living, and maybe some suburbs and areas that weren't traditionally the domain of the PRS will become popular. Opportunities for landlords maybe to pick up properties in slightly higher yielding areas. I think that's really, really interesting. I think you've also got the fact that, if we're looking at the immediate climate first, you've also got the additional stimulus that the government keeps bringing to the table in terms of the demand side of the property market, and sort of the extended stamp duty holiday and the government support for 95 side, and this is pushing property prices up all the time. I think that will force landlords to continue with sort of the PRA regulations that Steve alluded to then in 2020, proving difficult for landlords in many areas, and we're seeing more and more landlords balance their portfolio, whether that's investing in different geographical areas and balancing their portfolio with properties from the south, where you traditionally get in higher value, lower yielding, and properties up north where maybe the capital appreciation isn't so great, but they're 6 to 7, 8, 9% yield on single dwellings is still very possible. 12 to 18% yield on HMOs is still very possible in the north. So we're seeing more and more people adapt that way. The move towards multi-occupancy, the demand from tenants and landlords for that gives them a more robust model. I think especially if we see a correction to these price increases, if we see a correction in a couple of years or in the medium term, which we may well do, those that have got all of their portfolio in sort of higher asset areas, higher value asset areas that don't yield so well, if there's a stagnation in property prices, then they're suddenly going to have a business that doesn't generate significant yield and also doesn't represent any immediate capital growth. So we're going to see landlords want to balance that. But if we look at sort of, as both Dimitri and Steve said, if you look at how the landlords have had to adapt and change since July 15, when George Osborne, if I can mention his name in this, but when George Osborne made those tax changes for the landlord, I mean, there was a stat out the other day that there was as many SPVs for properties set up between 2016 and the end of 2020 as there was in the previous 50 years combined. Now that's a hell of a stat. That shows, and we see from our side, 78% of what we transacted last year in terms of buy-to-let purchases went through a limited company structure. We're seeing clients, accountants get more and more clever and cute with those limited company structures. And what it does do, it brings huge value to the market in terms of specialist lenders, the solutions. There's a lot to be proud of. Lenders have come up with all sorts of innovative solutions and continue to do so. It's important that those brokers that embrace the change and those landlords that embrace the changes, agile in their approach, are the ones that will continue to thrive and remain robust. But yeah, no, the landlord has proven a very adaptable animal, and certainly the modern landlord has to survive.
Thanks for that, Matthew. I could hear you quite clearly, but your connection was a little bit delayed in parts there. I'm hoping everyone else could hear you clearly. That kind of leads on anyway to my next question. You've obviously mentioned there, about all of the huge changes in the market and how important it is to have specialist lenders in this space. And it's also extremely important to have specialist brokers as well. Landlords need the advice and support of advisors now more than ever, especially when it comes to tax and different company structures. What advice would you give to landlords looking to secure finance now? This might be one for you, Alec.
Thanks, Beth. I think there's obviously a number of different factors that people take into account when taking on brokers to source finance for them. I think the market there's what the guys alluded to earlier. There's been a lot of sort of rules, regulations that have come into play over the last sort of 4 to 5 years. And to be honest with you, a lot of people, property may not be their main line of business. It might be a secondary income stream. So they just don't have the time to get involved and understand, the nitty gritty, as to say, what actually impacts them and what they should be doing, what they shouldn't be doing, who should they be speaking to, who shouldn't they be speaking to. I think they're employing this, our services more and more, because we have access to the whole of the market, so we can actually see from a high level overview of what's actually going on, who's doing what, who's not doing certain things in the marketplace. And I think from that perspective, when clients come to us with a transaction, say, look, this is what we want to do, it may well be now that, whereas 5, 10, 15 years ago, it was the high street banks that were doing, predominantly majority of the buy-to-let business. Now there's a massive vacuum being filled up by the specialist buy-to-let lenders now that, that are doing stuff that the traditional high street lenders are not able to do. So whether that's just an example, not the guys alluded to the PRA stress testing that was brought in a few years ago. Some of the lenders now don't necessarily do that on some of their products. So it just means that clients have more opportunity to, especially when they want to leverage a bit more. Let's say, give you an example in London, where the yields are so low, and generally if you go to a traditional buy-to-let lender, you're not going to get more than possibly 50-55% of the value of the asset. When you go to the specialist lenders, because they're a bit more flexible on their stress testing, you probably will be able to get more on a day one release, where sort of money on day one is important for clients, especially if it's an acquisition. So for me, it's the specialist lender market, it has filled a massive vacuum that's been there over the last couple of years. And now, with the opportunities that are out there for clients, with the lenders that are out there, I just think people like ourselves have the knowledge, know-how, the contacts, the expertise to advise clients that, okay, you may have been speaking to your Barclays, your HSBCs, whoever before, but in all honesty, they're not fit for purpose for what you want to do. Now, there is obviously a solution with, the specialist lenders that are coming in and are facilitating an increasing market share of the buy-to-lets.
Thanks for that, Alec. James, what geographical changes or living trends have you seen in buy-to-let investing since the start of this year, and why do you think that's the case?
I mean, obviously, we specialise in sort of London. There's been a sort of big change in what's happening there with the sort of, the pandemic over the last year. And yes, of course, there's been a push out. So people have outside space, they have larger houses, to work from home. I think working from a, one-bed city centre flat is obviously, less palatable than having a nice, house in the sticks. So I think there's definitely been a switch there, and I think the buy-to-let market will follow that. So, there's the one-bed flat in London, and we alluded to it before, offers a very poor return, and with so little capital appreciation likely to happen, I think it's going to be unappealing for anyone except for people with very, very low debt levels, because as I said, there's not going to be huge growth in many of these sort of flats. I mean, with regard to will this be a long-term thing, I'm doubtful, to be honest with you. I think people will first of all sort of move and they'll enjoy the outside space and the change, but I think people want to live in London for a reason. They want the vibrancy, they want the cultural, they want everything about it that makes London exciting. So I think what we're going to see is a lot of people move back. And I think as people start to go back into the offices, you'll get this, too old to use the acronym, but a fear of missing out. And I think people will come back into London because they want to be part of it. But it's not just socially, but I think in the office, is that you won't want to be sitting working at home when everybody else is in the office. So I think there is definitely a short-term geographical change, but I think it will be short-lived.
I find quite interesting on that point as well. If you look at a certain property type and how things can change so quickly. So I remember at the beginning of this time last year, there were people saying, "Oh, HMOs are done for because people aren't going to want to live with somebody else because of the coronavirus and the risk of infection and such." And actually, as the year's gone on, that sentiment has changed, I think, more to people are desperate for more social contact again. And actually, as a result of that, an HMO is perfect because people, that's now the most important thing. So I do think what's changed, things can change super quickly. And to James's point, you're right. Not that long ago, city centres, that's it, no more. No one's going to ever want to go back there. And actually, we're now hearing people are desperate to go back. And I think that will probably continue. So I just think there'll be continued change around both geographical and types of property. The reality is we'll probably return close to what we were pre all of this happening, but with a few changes that will probably stick.
Yeah, I think I agree with that. I think, funnily enough, it's probably more businesses which are going to reduce their office space rather than people not wanting to come back. So I think that's one area where we need corporate companies to be less sort of want for profit and more sort of socially responsible for the people that do want to come back, as opposed to seeing this as an opportunity to reduce square footage in London.
There's one other thing I think drives that question, though, that you're looking about where people want to live, but from a landlord's perspective, it's where do I want to buy? And as much as there'll be demand returning to London, and I think there'll be landlords that can facilitate that, what we've witnessed over the last few years actually is that it's not a geographical shift just this year. It's actually been a geographical shift, probably again going back to some of those issues that we talked about in the first question. And landlords, investing in property needs to be treated as a business, and if you're going to have a business, you need to make a profit, and that ultimately will see why there's a drive of landlords from the south looking further afield to sweat those assets and try and create that yield in them. So it's interesting to see how that's been changing, and from Octopus's perspective, we continue to see that. So obviously we have an office in Manchester. We've built a product that can facilitate lower value properties as well, so loans down as low as sort of 50,000, and we see a lot of demand for that. And I can actually see that sort of shaping as well from the north and the Midlands, and then even down to the West Country now, just where yields are strong. And interestingly, I think in terms of tenant demand, what I'm definitely hearing and watching sort of landlords talk about their assets and how they're working on social media is the demand from tenants is far outstripping the supply. So if you've got the right property in the right place at the moment, you're probably not struggling with voids too bad. And I think that again will underpin landlords may want to go one way, tenants want to go another. It'll be interesting to see if the balance is met across cities and other areas further afield.
Yeah, I'd jump in on that as well, Steve. I found when I talk to so many estate agents on a weekly basis, there's almost sort of tenant gazumping going on. Where you get a 3-bed flat up for £1,500 a month, and one guy will say, "I'll tell you what, I'll give you 6 months rent in advance, and I'll pay an extra £100 a month." So it's definitely, supply, is not meeting the demand at the moment.
Out of interest, with the kind of impending revitalisation of high streets, which a lot of people are talking about, and in terms of inquiries, are you seeing more landlords looking at these areas for buy-to-lets? This might be one for Dimitri or Steve.
Steve, do you want to say that one?
Yeah, well, I could just comment on my local area, which is quite interesting. So I live near Southend-on-Sea, and Southend High Street is literally 2 miles long, with probably half a mile's worth of shops that are still open. And they're piling a huge regeneration into this area. And it's going to be ground floor commercial with smaller units packed into 1 mile, and the rest is going to be residential throughout. And a lot of these are going to just be for letting purposes only. There's been a huge amount of interest already, and they haven't even started the schemes yet. And a combination of student accommodation going in there, some co-living, which is proving to be very, very popular. I know we funded some schemes recently. But I think if you're young and you're in your early 20s, you could live in a town centre in a nice flat, surrounded by all the things you want to do, coffee bars and nightclubs, and I think restaurants. I think it makes total sense for people to move into town centres in that way.
Yeah, I think the high street was changing, or has been changing for many years, and this has obviously accelerated it. And these huge shopping centres are obviously going to be replaced with either a bit of resi, but also smaller niche shops. And I think that's where I think is a good investment, and it's slightly different from a buy-to-let investor's sort of normal sort of resi, is looking more at sort of secondary retail or mixed-use buildings, because I think there is a fairly good demand for that type of business. And as people come back into the high streets, as David mentioned, a lot of them look like ghost towns. But if you start to blend it with resi, these smaller shops will start to attract businesses. And then you'll have, because they're relatively low rents, and I think they will survive, and people are very entrepreneurial and they want to start their own businesses. And what they've seen over the pandemic is a lot of startups happening. Well, that can be one area where it makes a good investment, because one, that they're actually quite cheap to buy at the moment, and therefore you have a chance of good returns. Because I think, again, the theme here is obviously the likes of London have really struggled when capital appreciation stops. It makes the whole buy-to-let equation fail, because you've only been buying these properties predominantly to get appreciation, and once that stops, then obviously it doesn't actually work as an investment. So I think if you start to look smarter, things like sort of secondary retail will give you the sort of 7, 8, 9, 10% return, which makes the investment work. And I think that should sort of accelerate the improvement in these town centres. So I think it's an area which obviously has risk, but the government has reduced that risk by saying, right, secondary retail shop, you can now go back to, or you can become residential, and suddenly your risk profile is hugely reduced. And as I said, I think you can still pick them up at a fairly good yield level. So I think it's an area which is certainly worth looking into.
Pardon my mute button, couldn't get it off. So I think we definitely do see some of that. But what's driving it really, and there's a big difference in towns in terms of what investment is going into that town. So I live just outside of London, and in my town here, so much investment going into it, and then off the back of that, you can see people jumping on wanting to pick properties and bargains, because there's going to be demand, because there's infrastructure going into that town. It looks very different, I think, unfortunately, to towns that perhaps just don't have that investment going into them at the moment. So again, that's where working with the likes of Dave so closely is brilliant, because what might look like a really good investment on paper, a good yield, a property bought at a really good price, actually when you go and walk that high street or that local area, you can see there's a lack of investment. There's obviously a reason why it's at that price, and there's maybe a bit more speculative. So I think it's, again, the classic location will be the kind of key to that.
That leads me on to my next question about where the biggest opportunities are for buy-to-let investors over the next few years. Where would you put your money if you were investing? This is open to everyone.
I'll jump in and go for one. So I think that there's two. It's a very individual thing. I will talk about where I put my money, but it's a bit of a case of, I think fortune favours the bold. You can see that if you had time to purely be a landlord and a property investor, I think you want to be looking towards the higher yielding assets, the HMOs, and even into potentially where you could use the benefits of short-term lets and renting your property part through Airbnb. The returns on that, if that's what you're looking for in terms of your walk-through property investment, and you want it to create a passive income or an income for you, and you want it to be as big as possible, then that's where you go. But the reason I kind of say that as a strategy rather than one I would approach is I think it can be very underestimated. When people talk about being a landlord, you often see associated to that is a passive income. And I don't think there's anything passive about being a landlord when your property portfolio is made of HMOs or Airbnbs. For me personally, and I think I watch on with envy of a lot of customers at Octopus, what I think looks really buoyant as a market at the moment is secondary properties coming to the market that are run down. They need works, but we're not talking excessive. So these properties could be valued between 50 and 150,000, and your cost of work spend maybe 20,000 circa, and then you're actually adding that value to the property. So if the strategy that I would want to adopt is to grow my portfolio, it would be where can I go and actually create capital so that I can refinance and go again. And I think for landlords, they refer to it as BRRR, which is buy, refurb, rent and finance. That makes sense to me as a way of, from a landlord's perspective, you're creating an income, you're actually building a portfolio. I think that's difficult to do. If your strategy was to go and buy say a T-bed in your local area, it's going to take you a long time to put a portfolio on that strategy in this market, I would say. So probably where I'd be.
Yeah, it's interesting actually on the bridging side of things. It is the most popular reason for people bridging with us now is to add that element of value to a property, and generally speaking to then retain and to let out. And the fortunate thing is that there is still an abundance of options in terms of refinance. Probably Matthew or Alec would be better placed for that. But once you've added some value to a property and the yield is reasonable, there are options out there where you can make that your play and make that your strategy.
Matthew, do you want to add to that?
My internet connection has been a little bit poor, so I apologise if I repeat anything that Dimitri or Steve said. But I think, something Steve has touched on a couple of times. I think the most important thing, holistically looking at everything, is that landlords realise, especially committed professional landlords, realise it is a business, and it's normally a multi-million business. And they have to structure it at the beginning. They have to work out what they want in their portfolio. Is it additional secondary income now? Is it an additional income for retirement? Is it part of inheritance planning? Is it a combination of everything? And once they decide what they want and how that's going to be achieved, they need to be getting the right advice on how that's structured. I think realistically, if I'm investing my money, it would be very much a balanced portfolio. I believe in that balance. I believe in having a robust portfolio, one that can be agile, not one that's dominant in a certain market that may change. I think it is beneficial to have some of the capital appreciation you would expect long term from the markets within the M25 and down south. I think it's absolutely imperative for those periods of property price stagnation, which you will encounter if you hold property for 40, 50 years, if it's there for inheritance planning, to have higher yielding properties, whether that's geographical locations in the north, whether it's HMOs, multi-unit freehold blocks. And something Steve and Dimitri have talked about there, which is absolutely imperative. If you're buying those properties now that aren't particularly going to yield a wonderful income immediately, you're looking where you can add value at the beginning, especially if that is your main income. And yeah, bridging finance specialist lenders such as Octopus can add some real value there as kind of specialist broker. But I think the most important thing is to work out where you go with it and what you're trying to do. Yeah, some fantastic deals right now. We're seeing lots of landlords remortgaging now, while property prices are maybe 15 to 20% higher in some regions than they were even just October, November time with all this government stimulus, and using that additional equity to maybe purchase some of the great opportunities that are obviously going to be coming up. I think the socioeconomic factors undoubtedly mean the PRS sector is only going to get bigger. You know, the demand for rent is and the population is outstripping house building consistently, and we have to find, as an industry, from lenders, from builders, from brokers, we have to find solutions to that in areas, city areas like London, where you can't just build more stock. There is going to be a huge demand, as Dimitri said, for the HMOs, for the multi-unit freehold blocks. You can't just go and build large housing estates there, and it'll be interesting to see how we adapt to it. But I think as an industry, we've done really well so far, but I think it's exciting times going forward.
Thanks for that, Matthew. Alex, did you?
Yeah, I was just going to add. I'm just going to echo what the guys have said. I mean, from just personal experience, what I'm seeing is new landlords coming in. As Dimitri and Steve have said, there just seems to be a lot of what they can do to enhance value. So they're looking at a secondary passive income rather than just buying a traditional 2 up, 2 down, or semi property. What can we do to add value to it? Whether it's increasing the floor plan, whether it's refurbishment, whatever it may be, just trying to add value and increase the income on it. For more experienced landlords, I'm seeing, I think the guys are seeing as well, a lot more people looking at HMOs, as you said, high yielding assets. People have got the experience, multi-unit freehold blocks. I mean, what I'm finding personally is when we look at those more specialist types of assets, they're probably for the people that have been in the industry for a number of years, know the rules and regulations that you need to comply. Because obviously there's a lot more bureaucracy, red tape that goes with those types of assets. But for the novices, first timers coming in, I just think I'm seeing a lot of people just wanting to buy property with an angle to refurbish it, and whether they want to flip it and then use the money to buy another property, or use that as a part of retirement planning. It just seems to be there's different parts of the market that are booming for different types of landlords, whether they're first time or existing straight professional landlords. So I pretty much echo what the guys are saying.
Thanks, Alec. David, are there any areas which you would think that landlords should or landlords should be avoiding in terms of geographical locations or asset types at the moment?
I think it's difficult to say, because it depends what you want out of your buy to let. Some people won't opt for HMOs because they think they're messy. If I go back through my sort of estate agency career, you go back sort of 25 years ago, an HMO isn't what it is now. An HMO was for people who couldn't afford to rent anything else. It was generally a bit of a bad landlord, probably didn't do any maintenance. Many of them had key meters in the rooms where the landlord could set his own rate of electricity to make a profit for the electricity from the tenant. I'll give you a good example. Strange enough, I went to Didcot yesterday, and I met a customer who's purchasing a 3-bed semi-detached house on a nice estate, where she could get planning and a license to convert it into an HMO. She's paying $300 for it, and at the moment, if you rented that as a house, you'd get about £1,200 to £1,500 a month as a house. She's spending 95 grand on it, room in the roof conversion, and a single-story extension at the rear under permitted development, and she ends up with 6 rooms that rent for $45,000 a year. So you can see the appeal there to go, maybe not buying a house in London, buying a house in Didcot slightly cheaper, and bringing your rental level from 15, 16 grand a year up to 45,000 a year. So I think, I couldn't highlight anywhere to avoid. You probably have to look at areas with mass oversupply. But if you're only buying it to rent it out, and you're going to rent it out for 10 years, for example, you would look, you wouldn't necessarily worry about an initial drop in the value and then recovering your capital value. I mean, from a purchase perspective, I'd probably stay clear of Slough Town Centre at the moment, parts of Battersea and Nine Elms. But as a rule, if you're buying it as a business, as guys were saying earlier, you've got to look at it as a business. You know, if you're not going to buy a property, buy to let it for 12 months and sell it, it just wouldn't work. If you're thinking long term, say 10 years, I don't think there's any particular areas I wouldn't.
Thanks for that, David. I think there's quite an emphasis on the long-term business prospects rather than just the short-term, which I think is really important to point out. Many borrowers are currently being left behind by mainstream lenders as circumstances change for landlords. How are specialist buy-to-let lenders plugging new gaps in the market? And I know, Octopus, you've obviously launched a product range in this space, so it might be one for you to kind of kick this off.
Yeah, absolutely. I'll take that first, and Steve, maybe you can add anything on top of that. So I think that, you know, the need for specialist lenders is greater than ever. I'm not just talking about ourselves, but the whole suite of lenders and the industry that we represent. And I think the interesting thing is, I always look back to thinking the clients that we're helping, they're not bad clients that the mainstream have decided actually these borrowers are no longer, you know, good enough. It's simply rules and regulations and how mainstream lenders treat them have pushed them into a different bucket that requires specialist support. I think these borrowers are high quality borrowers that were being helped for many, many years by different lending entities, that now actually it's the specialist arena that are able to step in and pick it up. I think the other interesting point is that a lot of us have come from the bridging or short-term space and now have, you know, extended our product range to include that. And I think that what specialists do really well is because we're quick, we're nimble, we come with that mindset. What we're truly able to do is look at what borrowers are asking for and design products and processes that actually meet that. And I think that that's something, unfortunately, that the mainstream simply don't do. They approach things as, here's our money, kind of prove that you're worth it. Whereas I think the specialist mindset is much more, actually, we would like you to borrow from us. What can we do to make that whole experience better?
Can I just jump in there, Dimitri? I think it's a really interesting point you made. I don't think it is in any reflection whatsoever, and perhaps the opposite of what people would expect in terms of the quality of the borrower, which is what you alluded to. What you actually tend to find, committed professional landlord, the one who's embraced change and the one who is most robust going forward, is actually the one in requirement of specialist lending. You know, vanilla lenders, it's not a derogatory thing. Vanilla lenders are set up for volume lending. It's a computer generated decision. There's not manual underwriting in the majority of cases. It is very algorithm led lending. Specialist lending takes us back to how lending perhaps used to be for those that's been in the industry long enough, but lenders moved away from it. But in terms of specialist lending, it's manual underwriting and it's understanding a proposition. It's where specialist lenders and specialist finance brokers really add value to situations. So they can look at the plausibility of a case and whether they should lend on its merits. You know, as I said, I think I said earlier, you know, the best part of 80% of the purchase transactions we transacted last year were through a limited company. On top of that, 40% of what we transact is some form of multi-occupancy security. I think when you take all of that into account, the role of the specialist lender is absolutely required. I think, you know, in terms of their innovation, you know, the government, which I know we may get onto later down the line, but the government are pushing for properties to be EPC rating of C and above, which at the moment there's 3.2 million properties that fall outside of that. So the refurb to let type products, the products that will allow landlords to get these properties into that type of shape. The specialist lendings are the ones who have been innovative and have supported landlords through these tax changes, through the regulatory changes of HMOs in 2018. Specialist lenders, and it's easy for me to say that with Octopus on the panel here, but I think everyone in the industry knows without the help of those specialist landlords, the market will be in much poorer shape than it currently stands.
I think I know just I mean, it's all, and again, just comment here. If anything about form, couldn't fit. We see actually now.
Oh, I'm not getting you, Alec.
Alec, I think you're breaking up a little bit here. Alec, I think you're breaking up a little bit.
Can you hear me?
That's a bit better. Do you want to try again?
Yeah, okay. Yeah. Sorry. What I was saying, just echoing what Matthew and Dimitri said. I mean, the traditional high street lenders, where they were more like tick box lenders. If it falls outside and we can't do it, and it's just that, sorry, we can't assist. What we're seeing now with the specialist lenders, obviously Octopus on the panel and a number of their peers, it's also a can-do attitude. What can we do to actually make this deal work? Fine, it might not fit certain criteria, but if we do it in structuring, well, for the what is the traditions, I think now are
You're breaking up again. Sorry.
that they have to turn in to get this is when I mean,
Sorry
Every
about
other
that.
word, every other word was good, but unfortunately, it's going to make with the gap.
That did just break up towards the end, so I've had to mute you, Alec. Apologies. I will hopefully be able to turn that back on shortly, and that will be better. I'm actually going to move on to the next question, which actually it might be one for you, James, about any positives you've seen in the private rented sector as a result of the pandemic and kind of changes to attitudes.
I mean, we sort of alluded to it slightly earlier, and I think that working mainly in London, we've actually seen probably more negatives than positives, because the flat market has really struggled, and people have been using their flats as Airbnb to try and increase sort of return, have sort of lost a large part of that market. So the only positive we've probably seen in London is people wanting to rent flats more houses on the fringe areas of London, the more suburban sort of type positions, and I think they have seen sort of much better demand. And if you go another step out into the home counties, again, we saw just after the pandemic people scrambling for any sort of large home and get themselves out of London. So I mean, that's certainly seen a mini boom. But as I said, I think we will see it return gradually. I think it will go back to where it was, and I think London needs it. Because it's the rental sector there is for smaller flats is really struggling. But once the overseas market comes back in, I think, and obviously they're not allowed to travel at the moment, it will change the whole sort of dynamics, and we'll start to see London return, and the rents, and then Airbnbs and all the good sort of yields come back.
So do you see the kind of profile changing in terms of
lip croaky again, sorry.
Is that a bit better?
Perfect. Yes.
Sorry about that. And so you were mentioning now, obviously, about overseas investors kind of coming into London, and that you expect London to return to what it was pre-pandemic in terms of investment. So do you see the kind of investor profile changing? So even though the amount of investment in London may return, it's just the actual borrower profile will be different to what it was before?
And not necessarily. No, I think you will see a continued, the overseas buyers, I think, will start piling back into London come probably Q3, Q4 this year, when they're allowed to sort of travel. I think they will be a similar demographics as they've always been. I think they represent nearly 50% of prime central London market. So I think that's an area which will continue, and it's they want to live in London. They want to be in the sort of major city, and as I said, they'll be desperate to come back in, and London needs it. I mean, funny enough, I was valuing a flat in London the other day, and it had been bought at, I think, 2.4 in 2011. It had been fully refurbished, and it was being sold at 2.1 now. So London has had a real, a very poor 5 years, and I think again investors are going to start to see that. And you may even get some buy-to-let investors who've been put off London because the yields are so poor, is actually seeing areas where there's potentially capital appreciation as well as slightly better, yield return. So where prime London has lost the best part of 20% in value over the last 5 years, it does, for the first time in a long time, look reasonable value for money. If you think we're back to 2011 money and almost sort of worse than that, then it must be an area where buy-to-let investors could be looking. But it is obviously, you need huge capital outlay. It's not, unfortunately for us mere mortals, but as I said, that market I think does have some legs in it.
Thanks for that, James. We mentioned a little bit earlier about
Can I just add?
Yeah, sorry.
Sorry, Beth, can you hear me?
Yeah, no worries. Go ahead.
Can you hear me, Beth? Yeah.
Yeah.
I was just going to say, I think it's really important. You asked about any possible changes towards the private rented sector, and I think one thing that has been completely or in large parts overlooked over the last 18 months and what's happened is if you take us back to this time last year when almost everyone self-employed was getting some element of aid from the government, the country was being supported hugely through the government. The one section of that was ignored and was actually leaned upon was the landlord, and they were obviously, understandably and rightfully so, forced to give tenants rental breaks and work with them, but at the same time they still had to pay their mortgages even if they were entitled to mortgage holidays. And I think what we have seen is how willing landlords were to take that and to work with tenants. And I really hope that maybe, without getting on the soapbox too much and without sort of taking it off tangent, I really hope that that this year and beyond is finally where the landlord loses its stigma that it's got within certain political parties and within certain media outlets. It has a huge stigma. When you look at the residential lettings market, contributes it employs over 60,000 people. It contributes over 5 billion, I believe, in terms of taxes. The role it plays in terms of the private rented sector, in terms of helping the homeless and vulnerable tenants, and the role it played in getting people through the pandemic and letting tenants live without paying their rent and managing that, and how lenders help with that as well. I think it's a long time coming that the industry stands up and is proud of what it contributes to society, which I think it does, rather than landlords carrying the stigma they have for many, many years.
Thanks for that, Matthew. We did mention a little bit earlier about the gaps in the specialist lending market and kind of how lenders are filling those at the moment for landlords. And I've definitely noticed over the last few months or so that there's been a definite rise in green buy-to-let mortgages, so products which are rewarding landlords for shrinking their carbon footprint and making their properties more energy efficient. Is this something you expect the specialist lending market to focus on a bit more in the near future as we look to build back better? And how else can the lending industry innovate further?
I'll sort of jump in with that. I mean, I think it's not really a case of like whether it's definitely coming down the track. I think Matthew mentioned earlier, in 4 years from now, all rental properties will have to have a certain EPC rating of C and above, and for new tenancies, and by 2028, all their properties will have to meet that same requirement. So it is happening, and I think lenders need to kind of do their bit to encourage and incentivise landlords. What I like to see with it is it become more than just a conversation around EPC ratings and how much further can we go. So I think when we look at this, it's talking about a green mortgage, and a green mortgage should be more than just incentivising your landlord to be as energy efficient as possible. I think there's actually responsibility for lenders as well. What can we do? I mean, we spend an awful lot of time visiting brokers. That's a carbon footprint every time a BDM gets in a car, which I think is the right thing to do. But equally, you have to be conscious of that. Every time a valuer goes out or an asset manager, again, that's adding to it. Every time there's paperwork that needs to be printed off, all of these things, in my mind, are part of the overall topic of what a green mortgage should look like. And I think lenders that are really focused on that and thinking about it, and we've definitely got a number of initiatives. I'm sure Dimitri's waiting for me to stop talking and jump in with some of the things we're doing. If you get this right, you're going to not only do the right thing socially, which I think is the most important part, but you should be a leader in this space. So it's an exciting one, but I kind of like to see the market not be purely fixated on EPC. It's an important part, but that's not a description of a green mortgage to me.
Yeah, Steve's absolutely right. I think green mortgages is far too narrow a subject actually when it comes to this. If you look across society and the world at large, you know, environmental social governance is very much here to stay, and I think it's moved from being a kind of nice to have, and potentially if you do those stuff right, it's going to impact your profit. Actually, I think it's going to flip on its head, and what we're starting to see is unless you get this right, you will be negatively impacted as a business. And I think that we as lenders probably have the primary responsibility within our sector to find ways to do that. I think those lenders that innovate better and quicker than others will have a huge competitive advantage in the next 24 months or so. At Octopus level, this is, you know, a huge topic of conversation. We just recently achieved our B Corp status, which fundamentally means we put, you know, the impact we're having on the world at large just as important as any profitability that's made. And we've seen a sea change across the group. I've got a working group that is actively looking at this on a weekly basis. I'm not going to announce any kind of initiatives today. We're still very much working on them. But yeah, watch this space from us, because this is an area that we firmly believe in. And I think that it's an area that we're going to do an awful lot in.
That's fantastic news, and I'm sure lots of people will be really pleased to hear what comes out of Octopus going forward in terms of sustainability. And also, just to follow on what Steve said as well, you know, just to look at energy efficiency is kind of just scratching the surface of this, and you know, even if landlords are looking to refurb or even kind of extend or convert properties, the actual way that we're kind of refurbishing and building and using modern methods of construction will also be something which I think there will be a bigger focus on going forward. And we're very close to the end, so I'm going to fit one audience question in, so we'll just have to have a quick answer. So this question is saying that landlord clients are continuing to seek out the strongest yields, which is leading them to increasingly look at HMO and MEV properties. However, there is a worry that this market of house sharing will be unpopular after the pandemic. Do you think tenant demand will continue or slow down, and are HMOs at saturation points? Would anyone like to answer that from the panel?
Yeah, I mean, I think there's definitely a risk of saturation of HMOs because it's becoming so popular. So I think that's going to be a slight concern. I think, as Dimitri sort of said earlier, is people actually like, on a well-run HMO, they like the whole community spirit of it. So I think it's still got a market, and demand will be there. But I mean, the reason why people love HMOs who are in that bracket is that, you know, you will pay an all-inclusive rent, which is lower than renting a self-contained studio, and you don't have all the sort of headaches of bills and everything, and that is what makes them very, very appealing. And now they are, when you see them, very, very well run, and as David alluded to, back in the 70s and 80s, they were sort of Rackman-esque, you know, sort of hovels, basically. Now they are very professionally run, and it's a good, you know, it's a good place to invest because, as I said, they're attractive to tenants to take up. But I am slightly concerned by the saturation of them. I think councils will have to start clamping down on room sizes, and they'll be charging council tax for individual households, which will affect sort of landlords. And you also have to look at that council get complaints from neighbourhoods who don't want the house next door carved up into 7 rooms and 7 households. So it is an area which does have its potential risks, but certainly at the moment, I think it's great for tenants. I think they seem incredibly popular, and I think it's good for landlords and rental returns.
Fantastic. Thanks very much for that answer, James. We are now at 12:01, so I think I will need to kindly bring the event to a close. We will be sending out contact details for Dimitri and Steve after this event, so if any of the attendees have any questions, please do feel free to send those in, and I'm sure that they'll happily answer those for you. So that was a fantastic discussion. Thank you very much to Octopus for partnering with us on this. And thank you also to our fantastic panel for taking time out of your busy schedules to be here. And I also want to thank you, our audience, for joining us. We will be publishing this roundtable in full next week on B&C for those that weren't able to make today's live event. And also if you fancied replaying anything you might have missed. If you enjoyed this one, we will also be having a further roundtable next week, so please do look at our calendar on B&C to check that out. And we're hosting events almost every week this year, so if you'd like to sponsor one, make sure to drop me an email at beth@medianet.co.uk. And also for more insight and news on the specialist finance sector, you can check out the latest issue of the Bridging and Commercial magazine, which landed last week. Have a fantastic rest of your day, and also bank holiday weekend, which is soon approaching. We look forward to welcoming you to our next event. Thank you so much.